Stop what you're doing. Seriously, if you own Hawaiian Electric stock, or really any utility stock right now, you need to see this 5-model valuation breakdown. $1.92 billion. Let that sink in for a second. That is a staggering settlement accrual staring Hawaiian Electric Industries right in the face. Think about it. This stock's intrinsic value could be totally detached from its current price, but in which direction? This $1.92 billion number represents an absolute fight for survival following those devastating 2023 Maui wildfires. The market is pricing this company like it's completely radioactive, but what if they're wrong?
Last week, I sat down and ran HEI's Q1 2026 financials through 5 distinct valuation models and 2 legendary investor checklists, and honestly, what I found completely shocked me. By the end of this explainer, I promise you're going to know definitively if this restructuring utility is a deep value Warren Buffett-style buy, or if it's just a classic Peter Lynch value trap waiting to crush your portfolio. Look, I get it. I know the absolute biggest fear for retail investors right now is catching a falling knife. It feels like stepping in front of a freight train, right? So today, we're cutting through the noise. I'm going to give you a crystal clear, actionable framework that you can steal right now to understand exactly what is happening with HEI's massive corporate turnaround.
Section 1. The Post-Wildfire Financial Reality.
Analyzing this company right now is honestly like walking a tightrope in a hurricane. I mean, just look at the sheer speed of this corporate pivot. In August 2023, the tragedy occurred. Fast forward to December 2024, and they completely sold off American Savings Bank just to raise some much-needed capital. Jump to April 2026, and boom, the first major settlement payment is out the door. And then, mere weeks later in May, crucial credit upgrades start rolling in. This is a massive multi-year restructuring, and it's happening at absolute lightning speed.
Now, to really understand this company, you absolutely cannot just look at the bottom line. It's totally skewed. We have to contrast GAAP net income with core net income. Why? Well, core net income strips out all those massive one-time crisis expenses related to the wildfires and their strategic reviews. You've got to use this core metric to isolate the actual day-to-day operations of the utility from the massive financial shockwaves of the crisis.
Let's move to Section 2, settling the tort litigation.
So, the absolutely crucial point here is how they're actually paying for this huge legal cloud hanging over them. The first payment of $479 million was successfully made in April 2026, and that was financed primarily through a $557.7 million common stock sale they executed back in September 2024. But here's the kicker. They aren't done. Not even close. The remaining payments are due in 3 equal annual installments. That means management is actively engineering a strategic financing plan right now, which is likely going to be a mix of debt to cover the rest of that balance.
Section 3. A pure-play utility transition.
To survive this ordeal, HEI has proactively transformed its very identity into a pure-play electric utility. They did this in 3 main steps. First up, they divested non-core assets, meaning they got rid of the bank. Second, they took those proceeds and used them to repay debt, specifically a ratable portion of their senior notes. And third, their unifying leadership. Effective June 2026, Scott Hsu steps up as the single CEO for both entities, creating a super hyper-focused corporate structure.
Section 4. Q1 2026 Earnings Breakdown. Okay, let's look at the actual numbers, because we're finally seeing real-time financial impacts. Notice that little uptick in net income? We went from $27 million in Q1 2025 to $30 million in Q1 2026. It's a modest stabilization in overall top-line profitability, and for sure that's largely because the absolute heaviest of those one-time strategic adjustments are finally starting to roll off the books.
But listen, in any corporate turnaround situation, cash is oxygen. And right now, HEI is sitting on a $1.5 billion enterprise-wide liquidity cushion at quarter end. That's a huge deal. It highlights their critical ability to keep the lights on, support ongoing operations, fund necessary grid investments, and most importantly, maintain the flexibility they desperately need for those future settlement payments.
But wait, we have to look a little deeper here. While that top-level income stabilized, the utility core net income actually dropped. It went from nearly $50 million down to just under $36 million year over year. So what's going on? Well, the daily cost of running the utility is just surging right now. Higher operations and maintenance costs are heavily weighing on the core business engine.
Section 5. Valuation and Credit Upgrades.
If we look at the broader market, it's pretty clear investors are still pricing in some serious risk here. A PE ratio of 16.42 and a price-to-book of 1.40 really reflects that caution. And crucially, you've probably noticed, the dividend yield is sitting at absolute zero. The board completely suspended it back in August 2023 just to preserve cash, and there is absolutely no indication it's making a comeback until the company finds much, much firmer ground.
However, flip over to the debt side and the momentum is totally shifting. Right after that global settlement was finalized, Moody's actually upgraded HEI to Bay2, and then Fitch and S&P followed suit, bumping them up to BB- and B+. Guys, this is an absolute game changer. It seriously reduces their access to capital risks and helps lower those future borrowing costs they are absolutely going to need.
Section 6. Headwinds and Future Outlook.
Now, we do have to balance that positive credit news with the stark reality of some pretty crushing operating margins. Management has explicitly said they expect 2026 operations and maintenance costs to literally outpace inflation. I mean, in just the first quarter alone, they were slammed with $7 million in severe storm response expenses, another $6 million in higher deferred insurance costs, plus rising IT and cybersecurity bills. The core business is basically in a vice grip right now.
All this margin pressure points directly toward a massive cloud of regulatory uncertainty. Because costs are surging, HEII is barreling toward a 2027 rate rebasing, which is essentially a formal request to regulators to hike customer rates to help cover these costs. At the same time, they're anticipating taking the maximum penalty under the fuel cost risk-sharing mechanism. Basically, they have to eat certain fuel price spikes themselves rather than passing them on to consumers. This sets the stage for a highly combative negotiation with the Public Utilities Commission.
And, as if legal and operational costs weren't enough, let's add long-term environmental mandates to the mix. Currently, over 63% of their power is still generated by petroleum. Only 37% comes from renewables. But Hawaii has a strict, legally binding mandate to hit 100% clean energy by 2045. Flipping that ratio from petroleum to renewables? Yeah, that's going to require billions, with a B, in capital investment over the next 2 decades.
Speaking of essential capital investment, you can add this to the ledger too, a $450 million wildfire safety strategy spanning 2025 to 2027. It's fully backed by the Public Utilities Commission, and about 2/3 of that massive sum is earmarked directly for capital upgrades to harden the grid. Obviously, it's an absolutely necessary investment for public safety, but man, it just adds another layer of really heavy financial obligation for the company.
So, this all leaves us with one final, vital question. Can HEI balance this incredibly expensive grid modernization with keeping power affordable for its customers? They're actively navigating billion-dollar settlements, strict green energy mandates, and surging daily operational costs. How they manage this super delicate balance heading into 2027 will define one of the most complex corporate turnarounds in the market today. The data is all right there, folks. You just have to keep digging.